Hey everybody, Preston Bryn here with our trader user group, a weekly roundup. This is for the trading week ending October 21st, 2016. What we're going to start off here on the screen here is the E-mini S&P 500 futures. You can see I've got a daily chart on the screen, but I'm going to clean it up for you a little bit and we're going to take a step back just a little bit. We are in a range-bound mode. I don't believe we're going to see too many longs or too many shorts committed to this market until we get through the U.S. Presidential elections, which are coming up here November the 8th. I know we got a lot of international folks that tune into our weekly roundup, so I believe that even though we're in the thick of corporate earnings, what we're seeing so far is that companies that miss, they are getting punished severely. Companies that beat, yeah, the price goes up a little bit, but outside of maybe Netflix or Microsoft, I think we're going to see some softness and fading of the price action for those that do beat, at least near term. Market and money seems to be a little bit nervous right now with the elections coming up and then a potential Fed rate hike. In fact, the markets are predicting about a 65 to 70% chance of a rate hike in December. We've got the Fed's meeting in one of their rare early of the month meetings this coming November 2nd and 3rd. And also on the 3rd, we're going to get the Bank of England, Mark Carney, coming out with what they're going to be doing. Everybody's really curious as to whether he's going to cut rates again and continue to pound the pound or let the markets take care of the pound and just let it sit where it is in the low 120s. We've also got the Bank of Japan coming up. So we've got a number of potential events, binary events, each one happening on a specific time and date, and I just don't see a lot of money, long commitments or short commitments before those binary events, primarily the U.S. election. Once we get through that, even though these corporate earnings are a mixed bag right now, we get some good earnings and we get some that miss. GE, which is kind of considered a global bellwether, did not hit what the markets were looking for, so that kind of put some weakness into the market. Yet Microsoft did. Honeywell did. Some of the tech. So we've got to be very careful here. What I've got on the screen again is the daily chart of the S&P 500 futures. Now let's just kind of take everything off the screen here for a second. I said we've been in a wider range-bound mode, and that is true. We've been in this range-bound mode going all the way back to last year, okay? And let me just kind of cap this on here like this. And, you know, we've had in September, we moved down below just a little bit right here and right here. But essentially, we've been in this range-bound mode. When we get down in this area down here, buyers seem to want to step in. But once we get up in this area here, there's just no new long commitments, right? There's just nobody that wants to commit to a long position. The other thing that we're seeing here, and I'll just draw it with my pen here, but you can see that we've got this down-sloping line right here, and then I could probably draw that like that. And I'm going to show you another longer trend line that comes back February of this year when we really came down. And it's just we're winding up here for an event to take place. And typically in a pattern like this would be more of a symmetrical triangle pattern. You're going to have it break in the direction that the pattern approached, or the price action approached the pattern. Now, we came in at the top, and you can see here it's a hard read. It looks like the pattern wants to break to the downside. Okay, I would call it right now around 50-50. The traditional symmetrical triangle, generally you approach a pattern like this and then you wind down and then boom, you shoot up because you approach the pattern from the bottom up. Or you come and you approach it from the top down and then you break to the downside because you continue the trend. However, in this case, with some of these big moves prior to entering this pattern, I give it a toss-up. That's what I give it right now. And I think that toss-up is going to be the determining nature of this toss-up is probably going to be the election. Although near term, we could see some movement because we've got some earnings. Next week's going to be an even bigger earnings event. Now, let me just show you, and I've seen a lot of people trying to show what key levels are on the chart, and I think they're missing something here. One item here, which is very simple in mind, is the low. Now, these are the E-mini S&P 500 futures. They're not the cash index, so you may see some trend lines a little bit different, right? If you're doing the cash index versus the futures, which are open almost the entire time. So if I connect this trend line here like this, and let's just connect the dots right here like that, you can see on this trend line here, we are fighting, and I mean fighting, to stay above this trend line right in that area here. Okay, now this started on the second dip down in February the 11th to be exact. That was the low for the year of 2016. Came down and touched it twice, and now we're sitting here and we're riding this line right here. And if I were to blow it up, you know, just to give you guys a much larger view for those of you that have, you know, eyesight that's not quite there, you can see here the open and the close, the open and the close, the open and the close, right? The open and the close, open and close, open and close, open and close. Granted, we've moved up higher, right? And the bar action shows we've moved lower, but we've really stayed in a very tight range. And most of that range, for most practical purposes, has been above the upsloping trend line. Okay? That's where it's been. And you can see that as I draw this down here like that, and then I could probably connect this one right here and draw that line like that, we're winding up for a pitch. It's probably going to be a fastball, but it may be a curveball because the market's like throwing curveballs. Like I said, earnings can move us up like this in a grinding mode. However, I just do not see a lot of longs being committed until we get through the presidential elections. The all-time highs are sitting right here, 2191.50 in the S&P 500 futures. I don't see us taking that out, clearly, even with good earnings, until we get through the elections, or unless the polls show that it's almost a guaranteed victory for one party over the other, and then you'll see the price action start to react. So now on the downside, we've got a couple of key pivots as well. Right here at 2100, the key pivot for us. And this price action just shows a little bit of weakness here. And then coming down, you can also see the 200 EMA that still has an upward vector to it. Okay, the 50 EMA, it's flat right now. All right, it looks like the line goes up, but it's a flat vector and a rising vector here. So one of these is going to have to give. Okay, now the 200 EMA generally trails the 50 EMA just because of the time frame. But if we break and we come down and then test this will be the first major test. Now we are using a day chart. So if you're trading a 15-minute chart or a tick bar or tick chart rather, or 1 hour, 2 hour chart, then it's going to be a different story. But on this daily, going out in time through the presidential elections, this is what we're going to be looking at, right? Right in this area here. 2100, call it 2100 even. Markets always overcorrect up and down, so I wouldn't say 2100.25. I'd probably call it, you know, 4 or 5 points north of 2100, 4 or 5 points south of 2100. It's just giving us kind of a support zone there. The other thing I would do is I will come down here, and if you look at this, guys, let's say we break this. If we break this 2100, there's not a lot stopping us coming all the way down here to 1980. I mean, there is not a lot. There is only one key level in this area right here, and that is roughly about what, 2037 or so. That is the opening price of 2016. Outside of that, we move into the red, and then we're going to challenge this line here, which was the Brexit, at roughly about 1982 and some change, right? So we've only got just a couple of areas below us that should it break, and I can almost guarantee you there are a lot of stops in positions below some of these key levels, and you could see it accelerate very quick if we blow through this area right here. But again, I do not believe we're going to get too far south or too far north before the election. And to give you an idea right here for the 2016 lows that were made back, Well, these aren't the 2016 lows. I'll show you the next step down, which is the 2016 low, which is even further down like this, down in this area here, okay? So 1802, so call it an 1800. So now each of these levels are going to be key levels for us. You can see the 200 EMA sitting at the 2100 roughly, 1981.50, 1802. Nobody and their uncle knows which way we're going. Absolutely nobody. There is one other major key level in here that I'm going to point out. And a lot of people have missed this, but we haven't. And it is a pretty important level here. We had back here last year a prior all-time high sitting at 2134 even. So if I were to just put this in right here like that, right? 2134. This area here was our all-time high, and it took us over a year and 2 or 3 months to actually break that all-time high. In fact, generally when the market set an all-time high, they have a pullback. They can usually come back and take that high out within a year. I think it took one of either the top 2 or 3 times on record to break the all-time high after it's already made one. So this is a significant level, 2134. And as you can see coming back over here, it served as support in this area here. And if I blow this up again on this daily chart to just kind of accentuate it, you can see right here, these are just some key levels that I believe are programmed in, and you're seeing people buy and commit or not. And you can see this 2134 area, which is sitting just south of the upsloping trend line here, which is just north of this next key level at 2100. Okay, now let's step it back out again, and I'm just going to give you guys an idea of, you know, what we're looking at here. Let me just move this up like this. So what are we looking at here as far as damage? If, let's say, we get a presidential election that doesn't suit the markets, and I'm not going to pick political sides right now. That's not my purpose. I don't, you know, I do care who's going to win, but that's beside the point in this session here. This session is designed that whoever wins, we want to make money, right? For our members, we'll go through the way to play it if the Repubs look like they're going to win or the Dems look like they're going to win. Because at the end of the day, you know, we want to make money on the trade, because that's what we do. So if we look at this here, and let's just look at the pullback. If we pull back to 1800, is that a bear market? I mean, would that cause a bear market? Well, if we look at these steps here, that first level down, roughly around 2100, is not even a 4% pullback. That is just, in the normal scheme of things, every uptrending market will pull back anywhere from 3 to 6% without even thinking about it. All right, now the next one, 1981, roughly. That's about a 9.53% pullback. It's not an official correction. An official correction starts at 10%, okay? Let's take it all the way down to 1800. If we come all the way down to 1800, right here, right? And then let's just do it so you guys can see right here. So now you can see at these key levels, 2100, 1981.50, and 1802, roughly, this is 1805, but let's call it 18%. An official bear market starts at 20%. So we can have all of these major levels broached, and we could be in a correction mode, actually, you know, give or take a couple of percentage points if we get down in this area here. Okay, I will remind you that back in February this year, we pulled back about 14% from the previous highs. If we come back to February, and if you'll recall, when the Feds raised their rates 25 basis points, it set the market on a tizzy. So I think it's kind of appropriate that we're going to, it looks like the Feds are going to do the same thing this December. So let's go take a look at it. If we start right here from the prior all-time highs, the 2134, we come down to that pullback right there. We got roughly about 15.61%, okay? So obviously that would not be as much as this one because we made new highs. But that was our pullback in December when the Feds last hiked the rates. Do I think that's going to happen this time? I don't know, but we could have the sun and the moon and the stars line up where the Feds hike the rates. We get a couple of bad numbers after they've raised the rates. Maybe the political election goes in a way that causes the markets to sell off. And next thing you know, we're down dancing with the devil down at this area here, just slightly above a bear market, an official bear market. Now, my members know, and I'm on record as saying that I believe we will have that bear market sometime in 2017 or early 2018. That pullback is going to be north of 25%, up to 35 to 40% pullback from the all-time highs. That's what I'm looking at right now. If we were to come to a weekly chart and just kind of look at this, I got everything off my screen here, right? So, or I've taken all my other indicators off the screen. Check this out, guys. So if we come down, and if you look at the prior all-time highs, right, they are pretty much aligned. Back in the dot-com bubble, we were here, and then back in 07, 08, before we rolled back over the end of 07, we came right back up and tested it again, and each time we fell a pretty darn good bit, right? And that is roughly at 1574. So we're going to measure the distance from the 2191 to 1574. That's where I believe we can go to fairly easy, okay? I just don't think it's going to be a big deal. It'll be a big deal if you're on the wrong side of the market. And just to show you guys, back in the dot-com bubble, we pulled down roughly about 51% was the pullback. The markets fell 51% in the dot-com bubble. And then in 07, 08, and that debacle that we had there, the markets pulled back roughly 57%. Okay? Most bear markets, just so that you understand, don't stop at 20%. They generally go on and keep going because by the time you've hit 20%, there's a lot of fear and blood in the streets. People panic. I think this time's going to be a little bit worse psychologically because people think the markets, we've been on a buy the dip routine since 2009. So I think the markets are going to be a little bit psychologically expecting a let's buy the dip, and every time they go long, it's going to run up, it's going to be a bull trap, it's going to roll over, and it's going to keep going lower and lower until finally there's capitulation. Once there's capitulation, then you're going to see buyers willing to come in. You're going to see the PE ratios start to change and go back down where we're not overly rich, but we're not at fair value. I think we're slightly higher than fair value right now. And keep in mind, there's only two things that really change the share price. One is earnings per share, where we're going through quarterly earnings now, and the other is interest rates. Interest rates compete for your money with equities. And when interest rates start going higher and higher and money says, well, you know, I can make a safer return elsewhere, I'm going to extract myself from equities. That tends to drive the PE ratios down until they get more of a fair value, and then you get a better return on your money, and then money comes back and the cycle starts again. So these are 51, 57% pullback. Now, what would the pullback be if we came down to the 1574, which to me I think is extremely doable from these highs, assuming we don't go up and make another high, right? Guys, look at this. It's only 28%. 28%. That is not, you know, in a really severe bear market, they're always over 30%. If you haven't lived through one, then you don't know what I'm talking about, and you can't feel the pain. Right now, I talk to traders, I coach a lot of traders, and they feel the pain, which is the 5% pullback or 6% pullback, and they are freaking out this past February when we had a 15% pullback. I don't know what the hell they're going to do if we go more than 25 or 30%. They're just going to probably have to take some sleeping pills and just, you know, say goodbye. So guys, expect this kind of move. I can't tell you when. I can't tell you what existential event is going to do it. If I knew, then I wouldn't be here telling you guys. But I do know one thing. You've got to pass through these key levels to get down there. That we know. And the market mood is going to shift. The sentiment is going to shift. The personality of the market is going to shift. It's kind of like a blind date. You're on a blind date. Things are starting to go good, and all of a sudden, it starts going downhill really quick. I don't care whether you're male or female, if you're on a blind date or whoever you're on a date with, it don't really matter. You know when things start to go downhill and you're like, oh gosh, I got to get out of this one, right? So same thing here. You know when things are starting to, well, not, let me rephrase that. Some of you know, many of you do not. You're going to do the exact wrong thing at the exact wrong time. You're going to be buying when you should sell, and you're probably going to be selling when you should buy. All right, so this is kind of where we're sitting right now, and there's this weekly chart with that upsloping trend line, and you can just see kind of how we're sitting on it. And this is the prior all-time high, and I've said this is like a bug zapper. It's just gonna, we had on this weekly chart, we had a breakout right here, and we just cannot get the energy to get much higher. And by the way, we hit my target up here within 8 or 9 points. My target was right at about 2,200, and we came up to 2,192. That was my target. So now, can we go higher? Sure we can. If we've got solid earnings and then we get some results in this election that are more favorable to price action, I've already said that we can run up to 2,250, possibly 2,300. But I do believe that it's a trap. It's not going to be another run up to 2,350, 2,400. I believe we're going to run into some problems and we're going to roll back over again. All right, but near term is all everybody's concerned with. So this is kind of how I'm seeing the markets right now. The other thing that I want to point out to you guys is, let me just put it back on the daily chart and we'll go take a look at volatility, because we use this chart all the time in our group. Let me go find it. Okay, here's the VIX. VIX closed this today at 1334. You can see I've got all these color codes on the VIX chart here, right? From green to yellow to, I don't know what that color is, purple to red to black. These signify zones within the VIX where we start looking at different option strategies for those of you that are option experts out there. And we use these just as a reminder, right, that, okay, we should be looking at these types of strategies once we get into these different zones. Now, we've been living in zone 1 where the VIX is less than 15 for quite some time. We have had spikes up, and you can see here that it's been, the market has been fairly quiet until we got into this, and this has just really been a fairly quiet time right in this area here. And then we started to get a taste right here, and then the markets went up to a black swan event up here with the Chinese devaluation of the yuan, over 2%, August 21st, 2015. Ever since this point in time, we've had, going back, the market psychology and the mood has shifted. We come down, we go up. 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 Now we are making lower highs on the vol. And then if I were to draw this line like this, it would look like, something like this. But vol doesn't play the technical analysis game like most charts and equities do. When vol reacts, it reacts stubbornly and very quickly. And it never reacts where you can predict the reaction. Okay, but we do know that when we're down in this level here, the odds favor it coming back up. And looking at the amount of times that we've had the spikes like this up here, really high levels, and then going back south of that, you'll notice the spikes almost were non-existent up into the zone 3 and zone 4 up here. So really starting, and then we had a little bit of a taste here, but then it was really quiet for a long time. And then right after the Chinese did their yuan thing, we don't go very far without having spikes in volatility. So this just says the dynamics and the mood of this market has changed. And I do believe that we're going to get some more spikes in this. Okay, so I could run the time sequence on this, but you guys get the idea. There are a lot of instances here where vol has moved up and then spiked back down again. A lot more than back over here when it was a lot quieter. Okay, again, it happened starting in August of 2015. So we get down here, we go for a period, and then bam, we go back up again. These periods here, we're not going to see that. That was the first part of 2015. and it was just like the market was asleep until the Chinese set the thing in a tizzy right there. And then ever since then, the markets are very nervous. So just keep that in mind, because we got a lot of binary events coming up in Q4 that can have a tendency to pop this vol back up into the low 30s or even the 40s if it's severe enough. Okay, so that is just one thing I wanted to show you here. The other thing is, now we're doing a lot of trades in uh, the bond market, and if you look at bonds and in the commodity market, you can first look at bonds. You can see how we've been following this track to the downside. This is a daily chart here. You can see we're just following this track down. We got a little bit of a divergence here, you know, so you can see from this low to this low here, we got a divergence. So that does suggest it wants to move back up into the center here. If we can get back up here, I will be more than willing to short it back up here, because every time we've hit this upsloping channel here, the play was to short it. And then when you get down here, you just sit and wait, because the bond market really has a hard time giving it up right now. But there's going to come a time when it comes down, we break some of these key levels, and this key support area here around 160 is very, very key. We break that and we're rocking and rolling to the downside. Now I'm playing it with TBT to the long side, which is just another way of saying I'm playing a long interest rate. Now the Feds have already come out and said they're going to hike the rate a couple of times in 2017. My guess, they're going to hike it once in December, and then the markets are not going to be as strong as the Feds think, and we're going to go back into this rain dance again in 2017 like we've been in for 2016. Will they, won't they hike the rates? You know, and Aunt B, aka Janet Yellen, she's just got the whole market in a tizzy and losing confidence over their ability to be able to communicate effectively to the market. And I don't know about you guys. I've listened to her talk and my head bounces off my desk. I don't understand. I don't think she uses English. She's the only one I know that can say day is night and night is day. So that should be clear for you, right? And you're looking at yourself going, what the hell did she just say? You guys are smiling now. You know what the hell I'm talking about. So you don't want to get too much in a tizzy. And the other thing is, even if they hike the rates or don't, sometimes the price action reacts completely different than you think. So at the end of the day, it just does not matter what they do. What matters is how price reaction reacts to what they do. That's what you got to follow. So we've been in a situation where good news is bad news and bad news is good news for several years. I think that whole scenario is going to start to change in 2017 as well. So we're going to start to have some correlations starting to get a little bit different next year as we finish out this year. Now, in gold, as most all of my members know, I've been more bearish than bullish gold after we broke out of this tight box up here. We're trying like crazy to hold this 200 EMA. I believe we're going to come down and test the 1200, maybe a little bit lower before we start going higher again. The other one that we're playing a lot is oil. Oil, I love this play up here. I love shorting oil up in this area here. We're running shorts. We're running ratioed short strangles in the oil futures market just because we're doing the DEES contract. So for our members that are following, we're doing very well in this thing, and we're just layering these things in and just taking the money as we can. You know, we're not doing it really crazy, but this is kind of what we're doing. There is no bearish divergence in this, so this is a valid move up. But I think after OPEC meets, which is I think November the 30th, or almost the last day of the month, or towards the last days of the month, then we're going to get some more reaction out of oil. I'm not betting on OPEC to do anything, quite frankly. It's like herding cats. They each have their own specific agendas. But it doesn't really matter what I think or what OPEC does. We got to watch how oil reacts to it. Even if they do some production cuts, I think over the next, let's say 12 months, oil is probably still going to be stuck below $55 to $60 a barrel. There's just too much supply right now. And demand, which most people aren't even looking at, has fallen a little bit. So these are just some of the quick overviews of what we're covering. There's a whole lot more going on. For our members, I'm traveling this weekend. I'm doing a seminar down in Florida. We will be back for our Tuesday morning session. For those of you that are non-members, I highly encourage you to come in. We're doing now secret trades where people follow me. We're doing very good since we started, and I've been doing it for a while. People are following the trades. We're doing really good. So our philosophy is holding up and has held up for quite some time. So check us out. I think you'll like what you see. Otherwise, members, I will see you next Tuesday morning before the markets open. Have a great weekend, and I will see you guys later. Ciao, everybody.